Moving on now to our next item, which is our first panel of the day, and I am delighted to introduce what I'm sure will be a fascinating discussion on driving the transition to net zero in a turbulent geopolitical environment, something that I'm sure we are all grappling with, and I can't think of a better panel to look at this. It is going to be chaired by Anne-Marie Verstraeten, the Vice Chair UK of BNP Paribas. Can I ask you to welcome Anne-Marie and her panel to the stage, please? Anne-Marie.
So good morning all. I think we have had quite a formidable warm-up already for this panel, but let me just recap on a few points which I think are important as we consider the many challenges and opportunities in this field. Indeed, we have in the last years moved from a world that had been globalizing for quite some time, where goods were flowing from production to users wherever, to one with shifting and increasing political tensions, supply chain disruptions, war, energy crisis, and escalating inflation. At the same time, we are all well aware that it is urgent for economies and societies to transition to a sustainable model, and that it won't be a just transition if it doesn't happen globally. The impact of climate change is stark, and the loss of biodiversity is becoming clearer by the day. The sixth assessment report from the Intergovernmental Panel on Climate Change, IPCC, reiterated the call to reduce greenhouse gas emissions very fast indeed, by 60% by 2035. And from the World Economic Forum, we have soundings of leaders globally that the climate, the climate challenge, the loss of mitigating climate impact, as well as extreme weather and loss of biodiversity are the top 4 risks in the global world for the next 10 years. I don't think we need any more evidence that this is absolutely, and as Anne and Peter, Ian also reminded us, this is the big change we all need to manage. And it comes, of course, as always, with challenges and opportunities. So in today's panel, we will look in this context at some of the themes which are recurring: the energy trilemma, or shall we say security, affordability, and sustainability combination, regulations, and increasing need of disclosure and reporting on climate issues, ESG data, challenge, opportunity, skill gaps, more of the same. So for this, I'm delighted to have with us a panel of individuals representing firms of which we can say we are all in. And moreover, we are here because we want to contribute to the debate. We want to share experience in order to really drive the transition. So I'm delighted to introduce Seb Henbest, who is the Global Head of Climate Transition at HSBC Holdings PLC, top level. We have Rick Lacaille, Global Head of ESG at State Street and previously CIO for State Street. We have Sarah Kemmitt, Head of Secretariat at the UN Net Zero Banking Alliance, well known to many of you. And to my left, Jake Reynolds, Head of Client Sustainability and Environment at Freshfields, and a veteran of the Cambridge Institute of Sustainable Leadership. Welcome all. Thank you very much for being here today. Jake, I would like to come to you first, and considering the geopolitical events, the economic headwinds of the last 14 months, the energy trilemma I just mentioned, what would you say has been the impact on our industry's ambition to transition to net zero?
Thank you, Anne-Marie. And just to pick up on that point about WEF and the environmental risks, they've actually been there for the last decade, really, really highly placed. And with reports like IPCC, which you also mentioned, I mean, the world should be fully aware of what is happening with the climate crisis. And I think the fact that we've been hearing just this morning already before this panel about the increase in flows of sustainable finance and some of the opportunities it's great to hear, and I'm really pleased that that is a focus of today's event. Those headwinds you mentioned are pretty severe, particularly over the last 12, 18 months. But I think in the grand scheme of things, I suppose I would think of them more as a wobble than a reversal of an important trend. And if anything, and this is sort of notwithstanding the tragedy of events in places like Ukraine and in conflicts all around the world, I suppose the tragedy of these geopolitical tensions as well, and the pushback on sustainability in some markets. Despite that, I would say that the focus on renewables and the focus on net zero has actually been given a huge boost. It's not necessarily the way that you would want that boost to happen, but nonetheless, I think it's been given a huge boost. The thing to remember is that net zero is not a paper target. It's not something that we have options over, that the physics of climate change mean that we do have to achieve it. It's a real target. It's not just something, it's not aspirational. It has to be done. If we don't manage it, the main impact is, of course, damage to the economy, damage to people's lives. The IPCC report is really clear about that. Any pushback on achieving climate stability is something which will cost lives around the world, and it will certainly cost economic performance. That much is really, really clear. So energy policy, agriculture policy, public policy generally is really about how we address that. It's the speed with which we allow the economy to be damaged by climate change, or on the opposite side, the way in which we invest in solutions to overcome that crisis. And I think the thing is we need to turn this around really quickly. And I was really pleased, in January, Chris Skidmore's report about the UK net zero did describe it as the major economic growth opportunity of the 21st century. So let's have some positive thinking about that. We've heard from Ian about sustainable shipping, electric ships. That's the tip of the iceberg, really. We have a huge investment in renewable energy capacity. The share of the energy mix globally is tilting towards renewables now. We've got hydrogen economy coming through. We've got building efficiency. We've got e-mobility, low carbon mobility. All of these things create massive opportunities for financing. We're talking trillions. We're not talking billions. It's going to get really, really big. And I think that should give us a lot of energy to think about these things. I'll finish by saying, if you look around the world, this is now becoming, hugely competitive. Economies, governments do not want to be left behind. You've got the Inflation Reduction Act, which is actually an investment of $400 billion in low carbon technologies in the United States. We've got the Green Deal Industrial Plan in Europe and the Net Zero Industry Act in Europe, which is trying to do likewise very competitively. We've got Chinese investment in what is becoming a superpower of renewable energy. I have colleagues in Japan who I was talking with yesterday. We have similar kinds of policies in Japan in green growth. All of that is changing the optics, and it's becoming far more central and far more mainstream, both in public policy but also in companies and financial institutions. So yes, a wobble, and the investment in oil and gas and coal, that's been continuing and going up is pushing against the grain, but I think in the longer scheme of things, I think we could be in a worse position.
Thank you very much, Jake, and we will obviously come back to some of the points that you have mentioned. Seb, I would like to come to you and talk a little bit about the transitioning the real economy has to do across a broad range of sectors. This, of course, inevitably meets with technical complexity. How do you feel we are coping with this? How, from an investment point of view, do you think this is progressing? Tell us a little bit about what you see.
Sure, and good morning, everyone. Great pleasure to be here. It's super complex, I think, is the headline. People describe this as an industrial revolution. I think about remaking the 747 in flight analogy. The idea of net zero has done one really important thing, though. It's meant that we've removed the risk of free riders. Because up until there was this idea of net zero, there was always this argument about who should do what, when. There was a moral argument about who ought to do what, when. And all of a sudden, we found ourselves, and the UK was a leader here, saying we want to achieve net zero. And zero means, no one gets to free ride. Everyone's got to get to zero, and the question is, how do you do it? And so industries that for a very long time were not engaged in this, were kicking the can down the road, all of a sudden started to ask themselves, how do we get to zero? The steel industry, the cement industry, the aviation industry, that together make up a really meaningful part of global emissions, are all starting to grapple with this. And that means that there's a lot of change all happening at once. And from a banking perspective, at HSBC is a microcosm of the world economy. So we have activities across all the major emitting sectors, from energy supply to autos and aviation and shipping and buildings. And we have to think through how our portfolio transitions over time in a way that is consistent with net zero. And we've set ourselves not just net zero, but 1.5 degrees net zero. So you can be net zero with all sorts of different temperatures. 1.5 degrees is an incredibly rapid and steep decline in emissions out of our portfolio. And there's lots of things we need to do to try and navigate that, and they, again, speak to the complexity of the challenge. We've set ourselves a net zero target, but how does that actually play out in the bank, both across sectors and regionally? Huge question. A carbon budget doesn't divide up very nicely. As I said before, the CO2 mixes in the atmosphere. As soon as you start to divide it up, you're starting to assign budgets to different activities. And that's a prioritisation exercise, and can get into this moral hazard area where you're saying who gets the extra budget, who doesn't get the extra budget. So what we've done is keep this at a global sector level and say, right, we need to look at every sector in which we operate, and we need to set ourselves some interim targets. Because if each one of those sectors can transition, then we're on a path to get to net zero by 2050. And the bank has a choice, like lots of financial institutions have a choice. You can either reallocate your capital away from the difficult stuff, or you can engage with the difficult stuff and use your capital to actually shift their activities to actually decarbonise the real economy. And in doing so, play a really meaningful role. And that's the role we're trying to play and hope to play. And we've now set targets for power and utilities, oil and gas clients, aviation, steel, aluminium, cement, auto, of course. And we've now got to work out how to move our portfolio to meet those targets. The other thing we've done to help navigate this complexity is to set ourselves some guardrails, some policies, things we won't do anymore. There's no good having one arm, really driving towards decarbonisation and the other arm adding emissions to the portfolio. We've got to, across the group, say these are the things we no longer have an appetite for, and these are the things that we will exit in time. So we need to work really hard to shift. Fundamentally, though, the bank and every financial institution is in the same boat here, has to understand transition pathways and the vectors of change, the technologies, how the sectors are going to evolve, what are the options, because this can't be we're not going to risk manage and comply our way to net zero. We've got to be bold. We've got to be able to work out what are the opportunities, whether they're the mature technologies that we have to drive capital into at scale, whether the nascent technologies that need the seed funding, the equity funding. And at HSBC, we're looking at that entire spectrum and thinking, how do we align our capital to it best? And a lot of the funding we do, of course, is direct to corporates. So understanding what they're doing in their plans is really central to this, so we can fund the company, not just the projects. And the last thing I'll say at this point is that whole endeavour of becoming a net zero bank and aligning is driven by the people in the organisation. Until a year ago, I was the chief economist at Bloomberg NEF. I'm an energy economist. I'm not a banker. I'm learning very quickly. And around me in our corporate sustainability group, we're bringing in expertise from industry, from government, to try and help navigate the bank. It's a huge rewiring exercise. We can have our bankers talk about opportunities with their clients, but unless our risk functions and our finance functions are all aligned and we've got a common strategic objective around this through the bank, front to back, across the world, we're going to find ourselves treading on each other's feet and not really making the progress we need. So bringing in expertise is really central to the HSBC approach to this. And I think this is so new that you really got to do something like that if you're going to make the impact you want to make.
Yeah. I recognize a lot of what you say. And when you talk about transition pathways, timetables, targets, there is also, of course, the need to review those frequently. And at BNP Paribas, for example, we have recently accelerated the decarbonizing in support of energy producing sector by way of lending and investing. So I think this dynamic approach of how we are doing as institutions is really important. But I'd like to come to you, Sarah. Obviously, from your vantage point, you recognize, hopefully, the things we are saying here today. Do you agree that there is a real momentum in the financial sector, looking at it from the NZBA since its inception? What are you seeing? And after that, I would like to come to the role of science.
Yeah, well, absolutely. At the UN Environment Programme Finance Initiative, we convened the private finance sector around setting norms and really helping the private finance sector develop guidance and implement these things that we were just hearing about all around the Sustainable Development Goals. And we actually, we convened 3 of the net zero alliances that are part of the Glasgow Finance Alliance for Net Zero, so the Net Zero Banking Alliance, the Net Zero Insurance Alliance, and we co-convened the Net Zero Asset Owner Alliance with the PRI. Coming to the Banking Alliance, I mean, we have incredible momentum. We now have 129 banks across over 40 countries around the world. We have about 40% of global banking assets in the firms that have committed to aligning their portfolios to 1.5 degrees. And as the UN, I'm sure it's no surprise that the framework that we have that underpins the Net Zero Banking Alliance is really focused on science. It's really that, you know, the absolute imperative for us is that it respects the 1.5 carbon budget, that we look at the, you know, the scientific reviews and assessments that come out from the IPCC. And as Seb just said, it's all very well kind of doing lots of green financing, but we also really need to be looking at the financing of polluting activities. And that's why our framework is completely based on decarbonisation targets for sectors. So our banks commit to setting targets in 9 high priority carbon intensive sectors. According to respected, credible scientific scenarios that limit warming to 1.5 with low or no overshoot. And, you know, the time imperative just cannot be overstated here. If we fail to bend down that global emissions curve, we are going to be burnt through our 1.5 degree carbon budget within about the next 8 years. So, you know, our theory of change is that the targets must be set according to science. But what happens is when banks set their targets according to science, they look at them and say, well, how can we possibly achieve this? So they do an assessment on the, you know, what they might be able to achieve through talking to their clients, understanding the policy framework. But in most sectors, we're finding there is a gap. And what's really central to our theory of change is to be able to understand that gap and really to then start to work with others. It's this deep collaboration that's required to talk to governments about the policies that are needed to enable that gap to be closed. One thing that we're finding as banks are starting to implement this is a bit what Seb was saying about the sort of the granularity of the pathways. We're starting, banks are starting to say, look, we need a pathway for this sector in this country so that we can really identify the technologies that need to be rolled out, what a credible 1.5 target looks like there. For some sectors, it's inevitable that there are going to be some residual emissions come 2050. Those are going to have to be removed. So while it's absolutely important for us to all respect the mitigation hierarchy and go for as deep cuts in emissions as we can as fast as possible, we do also simultaneously need to invest in carbon removal technologies, because I think there's no doubt that we are going to need them, but we can't rely on them being available at the scale that we would need if we fail to reduce emissions.
Sarah, can I push you a little bit on this? I think the discourse a few years ago when we talked about net zero was very much at that residual sort of topic, offsetting. And would you say that in the meantime, indeed, the understanding and the commitment to really reduce emissions and then some residual that we have to cope with through offset, that has got traction?
Yeah. I'd say in the last couple of years, there's just been such a building in understanding of what's needed. We need real high integrity in the carbon credit market. People need to understand the difference between an avoided emission or an emission reduction and an emission removal, a carbon removal offset. And we do need to be so careful about how we view the use of carbon credits in that journey to net zero. We can't offset our way out of this. We have to achieve real, we can't ignore the physics, the simple physics. If you're putting the emissions into the atmosphere, we're going to get that warming. And, just because you've avoided some emissions elsewhere doesn't negate that. I think we're moving in a really good direction, and there's an understanding that at the point at which we declare net zero, those residual emissions need to be removed. On the way to net zero, though, we don't want to discourage things like the preservation of forests or reforestation or, the rehabilitation of peatlands and all of these things that are going to provide some nature-based solutions. So we need to be careful that we don't create rules or norms that don't encourage that simultaneously.
Yeah, thank you. I would like to now go to Rick, and obviously, Rick, embedding net zero across organizations and business models, be it an industry or the service economy, requires a lot of learning and developing of new skills. And I think we've heard it again this morning, this is where both the challenge and the opportunity also lies. In our own organization, we have trained over 90,000 of our people. It comes back to your point, Jake, this is everyone's business, as you mentioned also, Seb. So at State Street, a steward of good governance, what are you seeing in terms of this green skills challenge at level of the companies that you support, invest in, provide services for, and at sector level?
Sure. Well, thank you very much. And again, by way of introduction to that theme, deglobalization and the political crisis has shed light again on this question of the net zero requiring us to focus both on the supply and the demand. So I think sometimes we simplify the problem and think about this I've said this before, a little bit like George Bush's war on drugs. You think about the supply side as opposed to the demand side, whereas we truly need an ambidextrous approach, and that's why these pathways and this sector approach is so important. However, that does require an understanding of what's feasible and what might be available from a technology perspective at a sector-by-sector level, and what might be more distant, so that when you're engaging with portfolio companies as an investor, you know what questions to ask about the way that the board is overseeing a transition or not in that particular sector. And let's face it, there are some sectors that are extraordinarily difficult. I mean, you talked about cement. We know there's a thing called green cement. We know it might be multiple times more costly than cheap cement, which can be produced anywhere in the world using a lot of fossil fuels and generating a lot of CO2. Who's going to buy the green cement? So, if I'm engaging with a cement company and I want them to transition, it's important to understand the dynamics of the industry to make sure I'm asking for something that's actually likely to happen, and I'm not engaging in magical thinking. So I think it is important. This skills question has a technical dimension, which is, what does the technology look like? Obviously, as an investor, you're not trying to micromanage the company. You're trying to ask whether the board understand the risks and the opportunities in the transition. But clearly, background knowledge, or more than background knowledge, sector by sector is very, very important. But I come back to that original point, which is that the geopolitical stress that we've had, particularly Russia-Ukraine, has shed light on this question of supply and demand. If we focus only on the supply, we know that we run the risk of energy security issues. So we absolutely need to be ambidextrous. And that means we need to embrace, in a way, the true complexity of the issue. Many people like a simple answer, but the reality is that this is an extraordinarily thing. It's like a massive state-planned economy exercise where you need to get from net zero. You need lots of different parts of the economy to change at the same time without necessarily having a carbon price or the other things that would naturally give the right signals. So I think the green skills are important at two levels. One is within investment firms, understanding what questions to ask and how to, in a sense, promote and support companies that are on that transition. The other is obviously at the portfolio companies themselves. They need to have an understanding, and we need to have a promulgation of better practices and better data. And I think UN and other agencies have been quite active in that area. Data is a big issue. If you're an investor, the most important data is not what happened last year, it's what's going to happen in terms of profitability and sustainable profits in the next 5, 10, 20 years. And unfortunately, that's often imponderable, and it's often subject to quite a lot of regulation. In other words, boards and management can't just put out statements about the future that don't have a great deal of certainty. There's a kind of integrity and a regulation question there. So the most important things we want to know as investors are about the future, and unfortunately the future is rather uncertain because of technology issues. If you pick a business or pick an industry like logistics, how is a logistics business that encompasses trucking, shipping, aviation likely to be on a path to net zero within the next 5 years? Well, it's not, because we know that aircraft won't be operating on electric. There may be sustainable aviation fuel. Now, 10, 20 years, if you widen the lens a little bit, you're going to get a great deal of more confidence in a way that technology comes to the answer. However, I think boards would have to be extremely cautious about offering hard forecasts as to what they're going to be able to do in 10 or 20 years. So I think all around the ecosystem, whether it's a banker or an investor, we've got to exercise judgment about the likelihood of those aspirations and targets being met, and be suitably critical when it looks like they're not being met. I think there is obviously a public discourse, and for those of you who haven't seen it, I'd urge you to watch the Make My Money Matter most recent video. It's fantastic and sort of infuriating, because the message basically is banks are still funding the fossil fuel industry. Stop putting your deposits with banks that do this. So again, it's simplifying enormously, but it demonstrates that there's a public trust issue amongst, between, the financial services industry and the public at large. And, we need to continue to work on this ambidextrous message in a very, very credible way. Say, yes, okay, we are still funding the fossil fuel industry in part, but we're actually addressing the demand side as well and looking for a net zero pathway.
On the ESG and governance, one of the points, I guess, that we also increasingly see is that now objectives for employees of organizations, be they financial or in industry, that is now making its way into the annual appraisal process, also linking it with variable compensation. In our organization, this is what happens, and I think it's probably the one objective that staff do not necessarily debate. They, in fact, welcome it. They want to be part of it. This is obviously good news, but complex. What are you seeing as you look across firms in terms of their own progress in that?
I think it's slow, but it is developing. I think, we do run the risk, and right from the board level downwards, of making compensation systems even more complex and potentially requiring quite a lot of wiggle room because we're dealing with uncertainty. And I think there's a great desire on the part of investors to make compensation as simple and as clear-cut and as accountable as possible. But I think we are seeing, certainly in sectors that are sensitive, that type of signal being developed. I think it's very important people respond to signals. I know that from our own organisation as well. When we set targets for senior executives around things that are very important to us at the total firm level, inclusion, diversity would be a good example, things start to happen. So I agree with you, Anne-Marie, that's a very important lever.
I would like to spend a little bit of time now asking the panel to share with us thoughts on how the progress we are seeing and the acceleration we need in terms of what Ian called a really solid triangle of industry, regulatory, and government. It's happening all over the world. Nevertheless, it is viewed by many as being slow. Money speaks loudest, and reference was made to the US IRA as well as the European Green Deal. So Seb, perhaps I would like to hear from you a little more on what was mentioned earlier, the credibility issue where ESG data are still can be difficult, but also is the progression we are making as a finance industry. Some people ask, is it genuine, or is it essentially a lot of noise, but ultimately financing businesses to continue to do what they have always done? Where are we with that?
Yeah, it's a tricky one. I mean, the starting point is that there was about $1 trillion invested in transition across different sectors and activities. Last year was a record. Every year's a record. Even through the financial crisis, there were records being set. So this is very much an upward trend, but that needs to triple this decade to get on track broadly. So you're turning $1 trillion into $3 trillion per year. So the role of capital is super important, and the question is, how do you deploy that capital in a way that helps at transition? And I think the starting point for us is the world isn't going to, and to your point about the demand side, the world isn't going to suddenly stop using fossil fuels because we stop our relationships that are sometimes decades long with energy companies. And so we have to be able to support companies where they're willing to transition, where there is a plan. We have to be able to do that. Now, you could call it transition finance. What I think of it is simply that the bank, to be a net zero bank, you have to rewire yourself so that all the financing you do is increasingly net zero aligned. So you can have certain products and describe it as transition finance, but ultimately our journey is to make sure that all the finance we're providing to companies, that we know that that money is being used to build those businesses in a net zero aligned direction. And that's, I guess, mainstreaming this idea. It's no longer an adjunct ESG type solution. It's saying the whole bank is aligning in this direction. And I think that's how we get around some of the skepticism that, oh, it's just another product you can sell. And that's not the idea. There are important product development, there's important product development to be able to accelerate this, to support those businesses that are making those emissions reductions. But ultimately, it's about getting and being able to measure and report, I think is very important, the climate-aligned financing that we do. We're very good at reporting the financed emissions, very difficult technically to do, to get all the data in place. What we haven't yet done is said, of all the financing we provide, how much is climate aligned? The only thing that can be measured right now are the green products and a few other minor facets, but the bulk of our financing is general corporate finance. And we've got no way of measuring that because we haven't yet done the work, and we're going to get there though, that says, right, of the money that we provide, how much is actually pushing down a transition pathway for a client? And I think at that point it will become much clearer that the work the bank is doing and the work that finance, the industry is doing, is actually supporting this transition, not just taking advantage of the transition in a cynical way. To do that, though, we have to be able to understand the transition plans of our clients. We have to have confidence that the finance we're providing is aligned or aligning to a net zero outcome by mid-century and is helping to achieve our targets. And I guess the final thing I'd say on it is that targets really matter. Targets that are linked to performance incentives at a board level really matter. They matter at HSBC. They matter in the clients that we work with. And meeting those targets and being able to watch a progression towards those targets with our clients is a way for us to be able to say, do you know what? This client is on track to support our objectives to be a net zero bank, because as part of our portfolio, they fit into that trajectory. There'll be some slow parts of the world. Emerging Asia will be slower than Western Europe. We know that. But across the portfolio, between the fast movers and the laggards, we're going to get our portfolio down. And we're on the public record with these targets, we're on the public record with our ambition. And I think it's going to be very likely that narrative and that anxiety about what the bank's role here is going to start to dissipate as that evidence presents itself over the coming 5 years or so.
Thank you. I want to accelerate a bit because we have some questions. But let me ask you, Jake, talking about policy, and obviously the UK was an early mover, putting net zero into law, very clear commitments. We recently had the update from the UK government on the green transition strategy. What is it doing? How is it helping? How do you see this as a supportive element for what needs to happen in the UK, but also for the city, the way it can progress our positioning in the world by what we are doing locally? Give us your take on the recent information.
Thank you very much. And I did this last time around, but just to refer to one of the answers we've just had on those incentives. When I was at CISL before Freshfields, we defined a sustainable company as one in which sustainability was good for your career. Forget all those metrics, the ESG metrics. Are you going to work empowered to actually deliver this vision? I think it's very, very important that every individual understands what their connection is to that bigger vision for it to really drive the kind of collective ambition of an organisation. But to the UK, I mean, look, the UK is really, and it's been a terrific leader in this space for a long time, but I think the mood music seems to have kind of gone off the boil a little bit. And I think it's probably the juxtaposition of UK policy with respect to what's happening in the States now, what's happening in Europe, and the kind of ambitions of many economies around the world, including China, to really take advantage and be at the forefront and generate the wealth through net zero technologies, or being at the vanguard of the kind of core industrial systems which we're going to have to put in place, including the finance, to reach these ambitious goals. So and I think Chris Skidmore's report in January really kind of nailed it. He did, take a good look at where we are in terms of not just energy policy, not just target setting, but the whole kind of using the whole machinery of government to drive this ambition through all of our regulatory bodies, every single area of policy, including education, including health, including local government. The whole thing needs to get aligned around this. Now, if that's not in place, we do depend on business and financial institutions kind of getting on with this themselves. And the really good thing, and we're hearing about that this morning, is that is happening. Just in our own experience at Freshfields, a lot of our clients are asking us, where are we on science-based targets? How easily accessible is our sustainability performance to them? How visible is it? Well, fortunately it is, because we put all that stuff in place. But what we're really seeking to do here is complete value chain alignment, which is where Zeb, I think, is coming from. The client is interested in their supplier's performance. Those suppliers are interested in their supplier's performance. And we're trying to sort of straighten out those supply chains so that everybody is on the same target. To do that really effectively, to do that across an economy, requires all of the requires an interplay between government, financial institutions and businesses. And it requires real leadership, and it requires an understanding that this area is now competitive. It's competitive sustainability. And I think that's a little phrase I think it'd be really worth all of us thinking about. We've moved past the point where this is something you bolt on and you do to create the right targets and appear sort of, civilized on international events. This is now competitive. Every part of the world wants a slice of the action. The $274 trillion, which apparently is going to be invested in the net zero economy to 2050, the $3 trillion a year, which we're trying to build up to. So how do we do that? And if you look at the report which Freshfields put together with the City UK, I'm really pleased to say it headlines on green finance. Give it a few years, 5 years maybe, we may not be talking about green finance. We may just be talking about finance. All of us will have that embedded as our priority. It will become just part of the furniture. That is going to be what the future of finance is. If we require 3 times global GDP investment in net zero by 2050, it's going to take over.
Yeah.
So that's really what can we say about the UK government? It's trying, it's doing lots of things. We should applaud that. But to be honest, this is a race now, and I think we need to be going even further.
Thank you. I think your comment on competitiveness has hopefully answered the first question I got from the audience about the role of pricing in the move to net zero. I think increasingly, indeed, we see competitiveness coming through. Many technologies are now more affordable than the conventional ones. I was at a recent conference where we had a speaker from India who was absolutely convinced that through microfinance, the region where he was from was really transitioning to renewable energy because it was the cheapest for families and companies to adopt. So we have a question that speaks to the just transition. And of course, in this inflationary world, transition and increased cost of living will be harder on some people who will be disproportionately affected. And the question is, to what extent can financial services companies help to address that? Or do we feel it is a matter for government? Anyone?
I can take a first stab at that. We're actually at UNEP-FI in the process of developing some guidance for banks for how to think about this very complex problem. It is very difficult. I think if you think about how we transition our housing stock, if we need to move all of our housing towards at least an EPC rating of C, and actually that's probably not even going to cut it. We probably need to go even higher than that. the rate that we need to achieve deep retrofits is just phenomenal. I mean, everybody's wondering how we're going to do it. We need surety of government policy. We need, accelerators to help the private sector to upskill and scale up really rapidly services for doing deep retrofits, and that's just not happening yet. But there is a real risk that those people that are least well off are in the poorest quality housing, the lowest energy performance ratings. These policies need to be brought in a way that then they don't become mortgage prisoners. They don't get into a situation where the value of their property drops because they've not been able to afford to invest £20,000 in improving the energy performance. So it has to be really thought about carefully in the design. But I think there's lots of innovation happening there, lots of solutions. There's things, different forms of financing like PACE, etc., that people are looking into as a way to kind of make this happen. But it's definitely important, because if we don't have a just transition, we won't have a transition, because there will be such a backlash from the public against it, and they will feel very, bitter. Why should I be bearing the costs of this? So it's absolutely vital.
Can I build on that? Because I think the consumer or the individual, the citizen's experience of this is really important. But cost of living at the moment is driven by international energy markets. It's not driven by a transition to net zero. That's really important. It's gas prices that's driving the cost of both gas and electricity somewhere like the UK, and disrupting energy markets across the world. One of the solutions is more renewables, because you have a zero marginal cost technology that actually overall lowers the average price of the electricity system. And as things become more electric overall, we're going to have cheaper energy in the medium to long term. But right now, gas is at the margin of the power system. So it sets the price. We've got a war in Ukraine, a gas crisis. We have high costs of living. 18%, give or take, of all the abatement activity that we need to 2050 will be done by households. Not in the sense that we're all going to have a climate epiphany and start changing what we're doing in life, or not living in the same way, but because the way we use energy is going to change and is changing. Between the solar panels we put on roofs, the electric vehicles in our driveways, the heat pumps we put in our buildings, the energy efficiency that we can retrofit into housing, you add all that together and there's a huge amount of product decisions and purchasing decisions. And HSBC, with a big retail bank, is actually quite well placed to help to bundle that. So we're looking at it now thinking, how do you bundle this set of solutions that helps to mitigate some of the cost of living crisis, to accelerates this net zero transition, and really allows a whole bunch of people for whom this is bitty and difficult and not their day-to-day life to actually do a lot much faster. We know buildings is probably the hardest sector to decarbonise. So there's a real nexus of really interesting things that all come together when we think about how people experience the cost of living, net zero transition, and what it means for their lives. And there's a big opportunity there, I think.
Well, on that positive note, we need to close off the discussion. Thank you all very much. I believe there is now coffee, so I think that we will be around for answering any further questions you may have. Thank you.
Thank you.
Thank you to the panel. That was a fascinating discussion. We are now, as Anne-Marie says, moving to the coffee break. And can we have you all back here, please, just before 10:45 for what promised to be another set of fantastic discussions and speeches. Thank you very much.